If you're not talking about these things with your advisor, you need to have this conversation, because you can have the best income plan in the world. You can have the best tax plan in the world, but one mistake in this area, right? If you have a healthcare mistake or an uninsured risk, it can totally derail everything else that you put together. Protection planning isn't pessimism. It's really one of the most important things you can do.
Hello, everyone, and welcome back to Retire Stronger, episode 43, where we are going to wrap up our 2026 planning and planning for a successful new year with a topic on basically healthcare and long-term care insurance and things of that nature, Medicare, all of these different things that are important when you're planning for your year. And Bill, welcome back, everybody. Bill Kearney with me, my co-founder of Crown Advisors and permanent co-host of the Retire Stronger podcast. Bill, say hello to everyone.
John, hello. Happy New Year. Hello to everyone out there. I see you've got your Carolina Panthers pullover on this morning, John. If you're listening here, this is the day after the Panthers have clinched their division and are going to the playoffs for the first time in 78 years. So, we're all very excited around here in the Charlotte area.
Oh, we are indeed. And it's I don't think it's the first time that a team has made the playoffs with a sub 500 record for the regular season.
No, the Panthers did it previous. The Panthers, I don't remember what year. I think it was like 2014 or 13, somewhere in that. But they were like 7-8-1. And they won the division. They got a home playoff game, and they beat the Arizona Cardinals in that home playoff game. So who knows what's going to happen? And
who knows what's going to happen? Who knows? So anyway, yes, go Panthers. Keep pounding, and looking forward to seeing what happens this coming Saturday. So by the time this episode airs and gets dropped on our different channels, we will have already known the results and the fate of whatever's going to happen next for the Panthers. So like you said, go Panthers, keep pounding. Hopefully we'll have some positive results to share. So, well, again, Bill, welcome back. I know we want to dive right in here. So I'm just going to turn it over to you and let you kind of kick off the episode for us today.
Sure thing. I know, previously we did 3 other episodes kind of in this series and, talking about income planning, investment planning, tax planning. And this is an area that is oftentimes overlooked by a lot of folks out there in our field. I think that's a mistake. And frankly, right off the top, I'll tell you, if you're not talking about these things with your advisor, you need to have this conversation. So we're calling this the protection and healthcare plan discussion. And it's important because we like to think that protection planning isn't pessimism. And sometimes these topics can be morbid and hard to talk about, but it's really one of the most important things you can do, because you can have the best income plan in the world. You can have the best tax plan in the world. You can have thought through all of the other aspects of your planning, but one mistake in this area, right? If you have a healthcare mistake or an uninsured risk or anything like that, it can totally derail everything else that you've put together. And we like to make light of this, John, and say, look, we get it. There's about 100 other things out there that you could be doing that are more fun and enjoyable than talking about a lot of these topics. But if you're at the point where you're uprooting and changing everything inside your plan, this is a great time to deal with this as well. So I'm going to dive right into some of the healthcare planning topics here, and we'll keep this high level. And this is a caveat. In our firm, personally, we don't directly deal with healthcare planning, with Medicare planning. We know enough about it to be dangerous, but we have team members that deal with this outside of our firm, people that we've added, if you will, to our team, to our taxi squad of advisors. And it's important because we need people who are experts in this area to help our clients. And certainly we can't know everything. So it's important to have folks like that out there. But let's talk, just about healthcare planning, in particular Medicare planning, Medicare enrollment timing. you as you get closer to age 65, this is when this really starts to kick in, because you've got enrollment windows you need to be aware of. You've got penalties if you're not enrolled in those windows at the correct time. There's some penalties that last for life by not doing them correctly. So typically, as our clients are getting closer to age 65, if they are not planning on triggering Social Security, because Social Security income triggering actually also triggers your Medicare enrollment. If they're not planning on doing that, if they're planning on waiting until after 65 to take Social Security in particular, that's when we want to get them in touch with our planning folks to say, hey, let's take a look at this. What do we need to do? What are the enrollment timeframes based on when you're turning 65, so that you have all of those? And a lot of people think that their employer coverage protects them.
No.
And that may not always be true. John,
Correct.
I think there's something you wanted to say about that.
Yeah, no, you just have to make sure that you're staying on top of that, because that just like you just said, it may or may not protect you from having to be required to apply for Medicare. And if you miss your window, like you said, penalties, all kinds of bad things that you don't want to have to deal with.
Right. So Medicare planning should really start about 6 to 12 months before you're going to turn age 65. I know in our case, it's hard for us to know exactly when that anniversary is coming up. We have automatic triggers that send messages out to clients to say, hey, get in touch with us. We need to start talking about this, or start getting ready to land the airplane in this area. And I know the other kind of kissing cousin to this is your Medigap, your Medicare Advantage. That all of this is very complicated for folks if this isn't what you deal with every day, right? And so kind of knowing what your options are here, what options you should take and what options you should make here are important. Again, it's important to know folks out there that can help you with this specifically. And then the other part of that is the prescription drug planning. The formulas on these prescription drugs and what's covered, what's not covered, the shifts inside of this, it changes from year to year. And
it does.
One medication change without you knowing it can break your plan. And we certainly don't want something like that to happen. So this is where annual reviews in this area, or adding this to what you're currently doing in an annual review, is critical, right? And so that might mean that once you hit 65 and beyond, that's a conversation you're not just having with your financial advisor, but maybe there's a healthcare advisor that's helping you with these things as well, to let you know just quickly, what are the changes that have happened inside of Medicare coverage, prescription drug coverage that I need to be aware of? Does any of it affect me, right? So just high level, 5,000 foot view of things that we think about or we think are important in that particular area. And John, I think the last point here is IRMAA, the Medicare stealth tax, right? This is the part of Medicare that affects your premium price based on income, right? This is where it's means tested, if you will. And IRMAA surcharges apply when your modified adjusted gross income crosses certain thresholds. So what could trigger this? Well, we talk a lot on this podcast about Roth conversions. So you could have 1 year where you have a Roth conversion that pushes you over the income threshold and triggers an IRMAA surcharge on your premiums. And that can raise those premiums, or will raise those premiums, for 2 full years.
Yep, 2 years, which is it's crazy to think about that one thing can trigger something like that for a 2-year period.
And IRMAA is not indexed to inflation. So you need to know, and just because you're going to get the IRMAA surcharge by doing a Roth conversion doesn't always mean it's a bad thing to do the Roth conversion. It might still make sense to do it, but you need to be aware.
You just be aware of it and plan for it.
Exactly. So we feel like tax planning and healthcare planning are 2 items that need to work hand in hand. A lot of times the focus is on the benefits of the tax planning, the benefits of Roth conversions inside your plan. Let's make sure this is part of that conversation as well. Remember, you don't just pay taxes to the IRS, you pay taxes to Medicare as well, based on the decisions that you make. John, I went through that pretty quickly, pretty high level. Anything else you want to add in that area before we move on to long-term care?
Yeah, I'll just say this, that, healthcare planning, the cost of healthcare should not just be a line item on your budget. It needs to be addressed and reviewed, just like you said a few minutes ago, on an annual basis, because these are things you can plan appropriately for if you're staying on top of it and tracking it and making sure you understand, the changes in your drug plan, the changes in your healthcare plan, whether or not you're going to have an IRMAA surcharge or not, whether that's being impacted by a potential Roth conversion. But at the end of the day, folks, these things can be planned for. You just have to make sure you're staying on top of it.
Just one other thing to put a pin in this is that your financial advisor, the person helping you with your investments, doesn't need to have all of the specific answers to every one of these points, but they do need to know the person who does.
Agreed.
And I think that's a critical part, is what does the team around that person look like so that you're having a holistic approach, because all these things matter in the end as far as planning is concerned, from an overall aspect of what you're going to pay, what things are going to cost, what your taxes are going to look like, all of that.
Absolutely. And, kind of moving from the healthcare side of it, where you can plan for what's coming up in the new year, what your costs are going to be, where the changes are coming into place inside that plan. We're now going to talk about a topic where you really don't have control over. You do not really have a lot of ability to predict or understand what changes are coming in the future, and that's long-term care planning. Basically, folks, planning for the what if. So, long-term care, Bill, it's not about dying. It's about living too long with the wrong plan. And the reality is, most folks either they think they're going to live a certain amount of time and just pass away and no longer have to worry about healthcare issues, getting sick, cancer, Alzheimer's, all these different things that can impact your daily life and wreak havoc on your financial plan if not properly thought through and discussed, and having a plan of action designed and in place to cover yourself financially if any of these things were to occur. Because again, it's not about anything that you can just say, hey, I'm going to have X number of dollars of expenses for long-term care this year. You don't know. And the cost of nursing home care or in-home health care, it's very significant currently, and it continues to increase on a very regular basis. And I don't know, Bill, if you have any statistics right off the top of your head, but I'm sure you might.
I do.
I was going to ask because I knew you might have something prepped for this.
Yeah, and looking through this, it's important. I mean, people are living longer. That's the whole reason that planning is such a big, important part of what we do. But in the long-term care space, right now, I mean, according to two sources that we look at a lot for data in this area, McKnight Senior Living and Golden Care, both have different surveys out there now that show that a couple that approaches retirement, there is a 75% chance that at least one spouse will need some type of long-term care coverage, whether it's in-home care, some type of stair-step coverage, or actually being in a facility. And then there's a 25% chance that both will need it. The key point there is not that, well, because I have a good chance that I'm going to need long-term care, do I need long-term care insurance? That's a separate question that I know you're going to get to. Yep. But the point is that because we're living longer, there is a much greater opportunity that one or both people in a marriage are going to need some type of long-term care coverage. So it's absolutely something that needs to be planned for.
Yeah, and when you say long-term care coverage, what you're referring to is the need for some type of long-term care facility like a nursing home or assisted living facility, or having someone taking care of you in-home, basically doing the same type of services that a long-term care facility like a nursing home would be providing for you at a facility. And those, the averages you just talked about, there's a 75% chance of at least one spouse needing long-term care services at some point in their life as they approach retirement. The average length of time that they're going to need those services goes anywhere from 3 to 5 years, or 2 to 4 years. There's varying averages that we've seen and statistics we've seen out there. So if you look at the cost of a nursing home at an average of around, for an okay nursing home, around $8,000 a month, if not more, in North Carolina, and you multiply that times 3 or 4 or 5 years, that's pretty expensive, and those numbers start to stack up very quickly. And so you mentioned long-term care insurance. Well, let's just talk about the various ways you could, cover the cost of such an expensive situation. You could self-fund, you could purchase long-term care insurance, or you could do kind of a combination of both. And quite frankly, self-funding, well, I guess, Bill, it kind of works well for high net worth households who have plenty of extra cash or savings on hand, to fund their retirement, to fund their goals, to fund the different things that they want to do once they stop working, and they have plenty of cash available to handle some type of major financial event when it comes to their healthcare. It does require a disciplined earmarking of your assets to make sure, hey, I'm going to make sure that I have a certain level of assets in place at all time to make sure I can take care of the financial burdens if something were to come up with my health. And I'll say this, that a lot of folks that we've worked with over time, there's quite a bit of emotional burden that goes along with, with self-funding for some type of long-term care event. And I think that is underestimated by a lot of folks. So that's something to keep in mind. So let's kind of talk about traditional long-term care insurance. It's basically a pure risk transfer. You're basically saying to an insurance company, I'm going to pay you a monthly, quarterly, annual fee. And then in return, if I qualify to utilize the long-term care insurance, you're now going to pay for my care for a certain dollar amount per month, per day, and for a certain number of years. It can be, I'm going to be very cautious how I say that. It can be cost effective if you start a policy at an early age. And correct me if I'm wrong, Bill, but I believe the earliest you can get a long-term care standalone policy is age 40, I believe.
I believe that is correct. However, I'm not going to go on record as saying I believe that is correct.
I've got to double check. I know that's what it used to be. I'm not sure if they've upped that age or relaxed that in any way, but I believe that's the case. But one thing I'll say is, even if you get a policy early and it's cost effective at the time you get it, the likelihood of your premiums increasing over time are very strong. It's what we've seen across the industry for many years now, and it can get costlier and costlier as time goes on. And that's why a lot of folks are turning to hybrid-based products, which are kind of combined with life insurance or possibly an annuity where you get a fixed premium that you're paying for a policy, and it has an added-on coupled benefit of the long-term care benefit plus the death benefit. It kind of appeals to folks who dislike the use it or lose it models, which is what long-term care insurance is, because you could own a standalone long-term care insurance policy, Bill, but if you never need the insurance, you've paid for a benefit that you never were able to take advantage of. It's similar to auto insurance or car insurance. If you never get into a car accident, whether it's your fault or not, and you never have to file a claim, it's insurance you've been paying for that you never use. Thankfully, right? At the end of the day, there's multiple ways you can approach the shifting of risk for the need for long-term care services. Again, you can self-fund, you can buy an insurance policy outright, or you can buy some type of hybrid policy that's out there. So, Bill, I'll let you, if you want to add anything in there, you feel free to do so.
Yeah, just one interesting part to this is it depends on when this conversation is being had with people. If they're in their early to mid 50s, you could look at a long-term self-funding strategy where, let's say, for example, you know what the premium costs are going to be for a long-term care traditional policy on a monthly basis. Well, what if you took that same amount and just invested it in a brokerage account for the next 20, 25 years and kept self-funding that monthly? If you're going to commit the dollars to an insurance company, what happens if you commit them to your account and that account is then built for that specific purpose. Obviously, this requires discipline, and it requires that you're not going to rob the account to go buy a boat or something like that, right? It is purpose for those reasons. But it's an interesting study to show people what happens to that money over 25 years at a particular rate of return, what that would look like, and how much money would be in the account to then use for that purpose. So just another kind of thought out there. It depends on when you're having this conversation as to how those options might look a little bit different in there. So, yep, John,
I agree.
Let's talk a little bit about life insurance. And do we need life insurance when we're in retirement, and how does that work? Well, life insurance in retirement age, the retirement age frame, is the same as it is when you're working, right? Because insurance is there to cover the risks that you can't afford, not the ones that you can. So there are still risks in retirement that maybe you can't afford, and that might be a reason why you keep some of the insurance that you had. So think of it this way, that it's the same as when you're working. When you're in retirement, you're looking for income replacement for a surviving spouse. Some things that might add on here that are a little different is maybe you want to have a plan specific for tax-free legacy for heirs. We have a number of folks who are doing that. They specifically open a plan as they get closer to retirement, and it's designed in a specific way to provide a tax-free benefit for their beneficiaries. And then the other part of this is estate planning, which we're going to touch on at the end here, some liquidity to pay for estate taxes or to equalize the estate among heirs and things like that. So it doesn't automatically become something that's unnecessary at retirement. And remember that in this case, the purpose probably means more at this point than the face value would typically.
Agreed.
So that's on the life insurance side of things. As we start moving more towards like property and casualty, of course, those are not going to go away in retirement either. You might find, though, that things like umbrella coverage are more important in retirement because you might have a higher net worth at that time, the higher potential for a lawsuit risk. And your auto and homeowners policies typically are insufficient to cover what you might need in this area. So as your net worth increases, that need for umbrella coverage and having that type of review is extremely important. We don't want you to be in a situation where one accident puts you in a position where it undoes everything you've done for a lifetime in saving on there. So umbrella coverage, and it's relatively inexpensive for an umbrella policy to look into. So if you don't have something like that, certainly we think it's great in the working years. It's certainly important in the retirement years as well. And the other part of this is property and casualty. Specifically our firm, we don't do and work in the area of property and casualty. But again, we have team members. This is their specialty. This is what they do. You want to make sure that your coverage limits aren't outdated or that you have inadequate replacement costs. If you've kept everything the same over the last 20 years, well, replacement costs have increased. So your insurance at that point might be insufficient. So if you had this reviewed in, say, the last 5 years, it's definitely something you want to have reviewed. Make sure you don't have gaps in between policies and things like that.
Absolutely.
So I think the overall theme there is that insurance policies tend to drift over time. Their purpose tends to drift. The coverage amounts tend to maybe drift away from what you actually need. So just having careful review there on what you have and where the gaps might be in what you have is important in this particular area.
I agree. Can go a long way to making sure that something doesn't go awry should you need the coverage. So certainly. And I know that we also wanted to talk about estate planning, legacy planning, things of that nature. I would say that for those that are maybe confused about why this is so important is Bill, estate planning isn't about death. It's about control. And I can't tell you how many countless conversations we've had with clients over the years where they have basically asked us, hey, how do I control how my legacy, whatever legacy that is that I leave behind to my kids, my grandkids, to charities, to whomever it is I decide to leave this legacy to, how do I kind of control it from the grave, basically, after I'm gone, so that I know that it's going to be handled the way that I want it to right now? And one of the best ways to do that is through different estate planning vehicles. And I think the most often overlooked estate planning and legacy planning review that clients just don't do enough of, especially on an annual basis, is beneficiary reviews. Bill, how many times have we found mistakes on beneficiary statements or lists for clients that they have on specific accounts, whether it's life insurance, 401k plans, IRAs, you name it. How many times have you done a review with a client and they have an ex-spouse still listed on their insurance or their accounts they have with us that we're managing for them? It blows my mind how many times that happens. Children listed incorrectly, trusts not coordinated with specific and proper account titles. These are all things that need to be looked at somewhat regularly to make sure that you are having everything go in the direction you want it to if something were to happen to you. Just as a quick reminder, folks, beneficiary forms override whatever it is your will says. So if your wills say that a specific individual is to receive 50% of your IRA, but you don't have that individual listed on your beneficiary statement, doesn't matter what the will says. The beneficiary statement is going to take precedent. And, I'll just say this, one outdated form can derail your estate plan, quite frankly. So again, reviews should happen annually, and especially after any type of major life events. So titling issues, these are also things that can come into play with your estate plan and your legacy plan. Incorrect titling can cause or can trigger probate potentially, can also create tax inefficiencies. We're big about being efficient from a tax perspective, so we want to make sure we don't allow that to happen. And so Bill, anything that I missed there or that you would want to kind of talk through?
We recently discussed this situation with a client who had their minor children listed on a $350,000 life insurance policy. They were 50-50 beneficiaries. Fortunately, the client has not passed away, so we didn't run into that situation, but caught it during a review and said, hey, you need to get this looked at and determine in your state what your options are as far as how would you do this? How would you, if your intention is for your children to be provided for, what's the best way to do that as opposed to directly attempting to give them that level of funding when they are 8 and 10 years old?
Absolutely. Well, Bill, I think that about wraps it up. Do anything you want to kind of say as a wrap up for today's episode?
No, I kind of have that feeling like I do every time we do this, which is we have about 17 or 18 more hours worth of things we could talk about just in this particular area. But we're going to keep it short here. And just let folks know that if these are topics that you're not sure you have all the answers to here, or you don't feel like you're going to be able to sleep on the windy nights, this would be a time to have that conversation with the person that you trust, and open the door and say, hey, I need to know whether or not I'm protected in these areas. Have I thought through these things appropriately? And if not, what do I need to do to fix this? Because I don't feel settled with where I am with it. Find that person that you trust and have that conversation as soon as you can.
Absolutely. And folks, if you're looking for someone to help you with this, or if you would like our help, you feel free to reach out to us. You can call us at 704-469-0200. You can email us at info@crownadvisorgroup.com, or also go to our website at crownadvisorgroup.com and hit that button to schedule some time to speak with us. And feel free to forward this episode if you found it helpful to a friend, family, or colleague, and hit that like and subscribe button on all of the different platforms where you can find us, between Spotify, Apple Podcasts, and YouTube, and others as well. We do appreciate your time and spending time with us today. We look forward to seeing you on the next episode. All right, folks. Thanks, Bill. See you soon.